The biggest investing mistake that cost millions. Have you ever wondered what the biggest investing mistake is? Is it buying the wrong stock, trusting the wrong company, selling at the wrong time? Surprisingly, the biggest investing mistake isn't any of those. In fact, it's a mistake millions of people make every single day. And unlike a bad investment, this mistake often goes unnoticed for years because it doesn't feel like a mistake at all. This is the story of David, a man who never lost a fortune in the stock market, never got scammed, never made a reckless investment. Yet somehow, he still lost millions of dollars, not because of what he did, but because of what he didn't do. And his story contains one of the most important lessons about building wealth. David was 30 years old when he got his first well-paying job. He was responsible, hardworking, careful with money. Unlike many of his friends, he avoided debt. He didn't spend recklessly. He saved every month. By all appearances, David was doing everything right. Every payday, he transferred part of his salary into a savings account. Watching the balance grow gave him a sense of security. It felt safe, predictable, comfortable. Whenever someone mentioned investing, David had the same response. Maybe later. He told himself he needed to learn more first. He wanted to understand the market better. He wanted the perfect time to start. And so he waited. A year passed, then another. The stock market moved higher. Companies expanded. Innovations transformed industries. Investors who stayed invested saw their portfolios grow. David noticed, but he still wasn't ready. There was always a reason to wait. The economy seemed uncertain. Markets looked expensive. News headlines predicted crashes. Experts disagreed with one another. So David kept saving and kept waiting. The strange thing was that he felt responsible. Waiting seemed like the safe choice. After all, he wasn't risking his money. He wasn't gambling. He wasn't losing anything. Or so he thought. By the time David turned 35, he had accumulated a significant amount of savings. Friends began talking about investments they had made years earlier. Some had invested in index funds. Others had purchased shares of growing companies. Many had already experienced substantial gains. David felt a little regret, but he reassured himself, "I'll start next year." The problem with next year is that it always becomes another year, and then another. Without realizing it, David had developed a dangerous habit. The habit of postponing important financial decisions, not because he lacked intelligence, not because he lacked money, but because he believed there would always be more time. Years continued to pass. David turned 40. His career was successful. His income was higher than ever. His savings account looked impressive. Yet something was missing. His money wasn't working for him. Every dollar he saved remained almost exactly what it was. A dollar. It wasn't growing. It wasn't multiplying. It wasn't building wealth. Meanwhile, inflation quietly reduced its purchasing power. The cost of housing increased. The cost of healthcare increased. The cost of everyday living increased. And although David's savings account balance looked larger each year, its real value wasn't growing nearly as much as he imagined. What David didn't understand was that wealth isn't built by saving alone. Saving protects money. Investing grows money. And without growth, financial freedom becomes much harder to achieve. And one evening, David met an old friend named Michael. They hadn't seen each other in years. As they talked, the conversation turned to finances. David was surprised to learn that Michael had accumulated a sizable investment portfolio. Michael wasn't a financial genius. He didn't have a higher salary. He wasn't lucky. In fact, Michael had simply invested consistently for years, month after month, year after year, without trying to predict the market, without searching for the next big opportunity. He simply stayed invested. David was shocked. How had such an ordinary strategy produced such extraordinary results? Michael smiled and explained something that changed David's perspective forever. "The market didn't make me rich," he said. "Time did." That sentence stayed with David. "The market didn't make me rich. Time did." For the first time, David began studying the power of compound growth. He learned that investing isn't about getting rich overnight. It's about allowing small gains to build upon previous gains. Year after year, decade after decade, like a snowball rolling downhill, starting small, growing larger with every turn. The true power wasn't in the returns themselves. The true power was in time. And David realized he had spent years wasting the one resource investors can never recover: time. Curious, David decided to calculate what might have happened if he had started investing when he first considered it. The numbers were painful. Imagine investing just a few $100s each month. Not thousands, not tens of thousands, just a consistent amount. Over 20 or 30 years, those contributions could potentially grow into hundreds of thousands or even millions, depending on market performance. The difference wasn't the amount invested. It was the number of years invested. Every year of delay dramatically reduced the final outcome. Every postponed decision carried a hidden cost. A cost that never appeared on a bank statement. A cost called opportunity. Opportunity cost is one of the most expensive concepts in finance, yet most people rarely think about it. When people lose money in a bad investment, they notice immediately. But when people miss years of compound growth, the loss remains invisible. No warning appears, no bill arrives in the mail, no alarm goes off. The consequences emerge decades later, and by then, the lost time cannot be recovered. That realization hit David hard. He hadn't simply delayed investing, he had delayed his future. At 42, David finally started investing, not because conditions were perfect, not because he suddenly became an expert, but because he understood something he had ignored for years. Perfection is the enemy of progress. The perfect time rarely arrives. Markets will always feel uncertain. News headlines will always create fear. Experts will always disagree. Waiting for certainty often means waiting forever. So David began, slowly, consistently, without trying to be clever, without chasing trends, without attempting to predict the future. He simply invested and stayed invested. Something interesting happened. The fear that once stopped him began to fade, because action replaced uncertainty. Each month he contributed a little more. Each year he learned a little more. His confidence grew, not because the market always went up, but because he finally had a plan, and plans create peace of mind. Years later, David's investments had grown substantially, not enough to erase all the years he had lost, but enough to change his future, enough to provide options, enough to provide freedom, enough to prove that starting late is still better than never starting at all. The lesson from David's story isn't that everyone should rush into the stock market tomorrow. The lesson is deeper than that. Many people believe investing is about finding the perfect stock, the perfect strategy, the perfect moment. But the greatest investors understand something different. Success often comes from consistency rather than brilliance. patience rather than prediction, time rather than timing. The biggest investing mistake isn't necessarily buying the wrong asset. It's waiting forever to begin. Because while money can be earned back, time cannot. And in investing, time is often the most valuable asset of all. Think about your own financial journey. How many goals have been delayed because you were waiting for the perfect moment? How many opportunities have been postponed until someday? The truth is that wealth is rarely built through dramatic decisions. It's built through small actions repeated consistently over long periods, month after month, year after year, decade after decade. The people who achieve financial freedom aren't always the smartest. They aren't always the highest earners. They're often the ones who simply started earlier and stayed consistent longer. David eventually understood a lesson that changed everything. The greatest risk wasn't investing. The greatest risk was doing nothing. Because doing nothing feels safe today, but it can become very expensive tomorrow. And that is why the biggest investing mistake that cost millions wasn't a market crash. It wasn't a bad stock. It wasn't a financial scandal. It was waiting. Waiting for certainty. Waiting for confidence. Waiting for the perfect moment. A moment that never came. If there's one thing to remember from this story, let it be this. Your future wealth is shaped less by dramatic decisions and more by consistent action. You don't need to know everything. You don't need perfect timing. You don't need to predict the future. You simply need to start, because every year matters. Every month matters. Every decision matters. And the earlier you begin, the more powerful time becomes. Small steps, big wealth, long road.